Here is a fact every New Zealand dollar trader needs to hear right now. As of this Saturday, July 25, 2026, the Kiwi is pressing against one of the most consequential resistance levels in its recent history, the 0.5800 handle against the US dollar. And the bulls are visibly struggling to push through it. This is not a minor technical level. The 0.5800 zone has acted as a ceiling repeatedly, and the recent failure to break convincingly above it is exactly the kind of early warning signal that separates traders who protect their profits from those who surrender them. The Kiwi climbed all the way from around 0.5700, the level where it was trading back in April 2025, to its current position near 0.5800. That represents a substantial rally. But right now, at this exact moment, the momentum that powered that climb is fading, and what happens at this level over the next few sessions could define the direction of this pair for weeks ahead. To understand today's situation fully, you need to look at the last 48 hours of price action. On Thursday, July 23, NZD/USD was struggling below the 0.5800 level. The bulls were present, but they were running out of momentum precisely at that barrier. By Friday, July 24, the pair had gathered just enough buying pressure to officially test 0.5800 itself. However, and this is the critical point, it could not sustain a clean break above it. In Forex trading, this pattern is known as a test without conviction. When a currency pair approaches a major round number like 0.5800, the psychological weight of that level attracts two opposing forces simultaneously. Buyers who entered lower look to close positions and lock in their gains. New sellers see the level as an opportunity to fade the rally. On Friday, those two forces collided squarely at 0.5800, and the sellers had the upper hand. That shift in momentum is precisely what traders need to watch closely heading into next week. The technical picture here is telling a clear and consistent story. The 0.5800 level is functioning as firm structural resistance, and the inability to close a daily candle convincingly above it carries real bearish significance. Below the current price, the first layer of meaningful support sits around the 0.5750 zone. A sustained break below that level would open the door directly to 0.5700, the region where the Kiwi spent considerable time during April 2025. On the upside, a decisive daily close above 0.5800 followed by genuine follow-through buying would be the one signal capable of shifting the short-term bias back to bullish. Momentum indicators add further weight to the cautious outlook. When a currency pair tests a key resistance level repeatedly without breaking through, and momentum readings begin turning lower from elevated positions, that combination is a textbook setup for either a reversal or a protracted consolidation. The NZD/USD chart right now fits that description almost perfectly. The New Zealand dollar is a commodity-linked currency, meaning it has a close relationship with global risk sentiment and commodity markets, particularly dairy and agricultural exports, which sit at the heart of New Zealand's trade profile. The rally that carried NZD/USD from the 0.5700 region to its current test of 0.5800 was underpinned by a broadly positive global risk environment over recent weeks. When investors are in a risk-on mood, currencies like the Kiwi typically benefit as capital flows away from safe haven assets. However, that supportive backdrop now appears to be losing energy, which is reflected directly in the fading momentum near 0.5800. On the US dollar side, Federal Reserve policy expectations remain a dominant driver. Any signal that the Fed intends to keep rates higher for longer would strengthen the greenback and apply direct downward pressure on NZD/USD. Meanwhile, any perception that the Reserve Bank of New Zealand is leaning towards rate cuts would itself act as a headwind for the Kiwi. The failure to break 0.5800 cleanly is already shifting trader behavior. Short-term momentum traders who entered NZD/USD from lower levels are now weighing whether to lock in profits rather than risk giving gains back at resistance. Swing traders are reassessing their frameworks, moving from a buy-the-dip approach towards one where fading rallies near 0.5800 becomes the more attractive strategy. Institutional desks, which carry significant weight in major currency pairs, tend to reduce positions when a key level fails to break after repeated attempts. That institutional behavior creates a self-reinforcing dynamic. The more often price stalls at 0.5800, the more traders treat it as a reliable ceiling, and the more selling pressure accumulates at that zone on each subsequent test. This is not panic. It is a calculated repositioning, and it reveals a great deal about where the probabilities are stacking up in the near term. The risk-reward balance is tilting in favor of the bears in the near term, and it is important to understand exactly why. If NZD/USD cannot produce a clean break above 0.5800 in the opening sessions of next week, the base case becomes a pullback towards the 0.5750 support zone. A confirmed break of 0.5750 would then put 0.5700 squarely back in focus, representing a potential move of around 100 pips from current levels. The bearish case would be reinforced by stronger than expected US economic data that boosts dollar demand, or by any deterioration in global risk appetite that tends to hurt commodity currencies most acutely. Negative domestic data surprises from New Zealand, including weaker trade or inflation readings, could also accelerate the downside. If you are holding long NZD/USD positions, you should be clear on where your stop losses sit and whether the current setup justifies the exposure. A balanced analysis must address what it would take for the bulls to regain control, because the bullish scenario has not been ruled out entirely. A strong daily close above 0.5800 with genuine follow-through buying in the next session would be the clearest signal that the resistance level has been overcome. In that scenario, the next upside targets would be the 0.5850 area, followed by a potential extension towards 0.5870. Fundamentally, the bullish case would be supported by a weaker-than-expected U.S. jobs report, or by any dovish language from Federal Reserve officials that softens dollar demand across the board. A positive surprise from New Zealand economic data, or a meaningful improvement in global commodity prices and risk sentiment, could also provide the Kiwi with the tailwind it needs. The bull case exists, but it currently requires a fresh catalyst to materialize. Without one, the technical picture continues to lean towards the sellers. Looking at the near-term picture heading into the week beginning July 27, 2026, NZD/USD is sitting at a genuine inflection point. The short-term bias has shifted quietly from bullish to neutral to bearish, driven by the failure to break 0.5800 with conviction over the past two sessions. The most probable path in the immediate term is either a consolidation phase or a shallow pullback towards the 0.5750 to 0.5760 region. Traders will need to watch for any fundamental catalyst to break the current stalemate. A clean daily close above 0.5810 would challenge the bearish bias and require a fresh reassessment. However, based on current evidence, including fading momentum, persistent resistance, and the absence of a new bullish catalyst, the balance of probabilities favors a move lower before any renewed attempt at pushing higher. The economic calendar for the coming week will be critical. U.S. data releases and any Reserve Bank of New Zealand commentary could be the deciding factor. Here's the clear takeaway for today, Saturday, July 25, 2026. The Kiwi has done the hard work of rallying from the 0.5700 region all the way to the test of 0.5800, but that very test is now acting as a warning sign rather than a launchpad. Bullish momentum is fading, resistance is holding firm, and the technical setup is tilting towards the bears in the near term. The 0.5800 level is your line in the sand. A convincing daily close above it changes the picture to bullish. A break below 0.5750 confirms that a pullback towards 0.5700 is genuinely underway. Whatever the outcome, trade the setup in front of you, not the one you hope to see. Manage your risk carefully, wait for confirmation before committing to a direction, And keep a close watch on both the US and New Zealand economic calendars next week for the catalyst that will ultimately decide this pair's next meaningful move.